Welcome to the deep dive. Today we're tackling something really central for any long-term investor. How do you even begin to manage the uncertainty around future stock returns? It's a huge question. So we're going to dig into some sources discussing how to forecast, say, 10-year global equity returns. Our mission, find the most reliable predictor out there. Your investing compass, basically. All right, let's get into it. So the fundamental idea, the real core of it, seems to be that the price you actually pay for something, that's the biggest driver of your long-term return. We often hear about PE ratios, price to book, standard stuff. But, well, they can be tricky, right?
Yeah, they really can. They get timed around by economic cycles, like short-term ups and downs. Makes them kind of misleading sometimes. What's fascinating here, though, is this thing called the cyclically adjusted price-to-earnings ratio, or CPE. So it's called the Shiller PE.
Shiller PE, right.
Popularized by Robert Shiller and John Campbell, yeah. But the idea actually goes back to Graham and Dodd, classic value investing. Yeah. How it works is you take the current price, adjusted for inflation, the real price, okay? And you divide it by the average of the last 10 years of earnings, also adjusted for inflation, real earnings. And that averaging over a whole decade, that's the key. It smooths out the business cycle noise, the peaks, the troughs.
So you get a clearer signal, more stable.
Exactly. A much better look at the underlying valuation. And historically, it's been pretty good at flagging, dangerous times.
Like market tops.
Yeah, think in 1929, the dot-com crash, 2007-08, KP was flashing red in those periods, like a warning light.
That is a compelling track record for the big peaks. But has it ever, cried wolf or been maybe less clear any times its signal wasn't quite so sharp?
That's a fair question. Look, no indicator is perfect, right? It's not crystal ball. There have definitely been times, like through a lot of the 90s bull market, where KP looked high and stayed high for, longer than maybe people expected. So it's more of a long-term compass. Definitely not a short-term map or timer. But the evidence statistically is quite strong. The R squared, which measures how much it explains, it's around 0.4 euro for predicting 10-year real returns going forward.
40%. So nearly half the variation in future returns is linked to that starting KP value.
Pretty much, yeah. But 40% predictable just based on how expensive or cheap things are when you buy.
And what I found really striking looking at this is how poorly those backward-looking growth numbers do. Just assuming past growth continues.
Oh, absolutely. Little to no predictive power there.
Some research even called it harmful for forecasting. Harmful. Why do you think people fall into that track so often, chasing past winners? Seems obvious it's like driving, looking backwards.
It really does, doesn't it? It's classic behavioral finance, I think. We're sort of wired to extrapolate, assume the recent past is the new normal. But markets, especially valuations, they tend to mean revert over the long haul. High valuations tend to lead to lower future returns, and low valuations to higher ones.
Right.
So if we want to build a forecast using KP, how do we do it? We need building blocks.
Right.
Think a total return coming from three places: income or yield, then earnings growth, and finally any change in the valuation multiple itself.
Okay, yield growth, valuation change. Makes sense.
Now, for long-term forecasting, like a decade out, the standard prudent way is to assume that valuation multiple change is zero. Reverse. It might go up, might go down, but over 10 years, assume it ends up back near average.
So focus on the yield and the growth.
Exactly. And for yield, the best measure here isn't just dividends. It's the cyclically adjusted earnings yield, the CAEY, which is just 1 divided by the CAP ratio.
The inverse of KP.
Precisely.
Yeah.
It captures all the earnings, including money used for buybacks or reinvested in the business, not just the dividends paid out. Then we need growth. We estimate long-term real earnings growth, maybe around 1.5%. That kind of lines up with what the World Bank and IMF are saying about global GDP growth, potential slowing down.
Slower growth ahead globally.
Seems likely. And finally, you add inflation back in. Let's pencil in, say, 2.5%, again, based on IMF forecasts.
Okay, so we have the framework, CA2Y plus real growth plus inflation. Given all that, where do things stand now? What's the KP telling us about today's global market? Is it looking expensive?
Well, yes, particularly globally driven by the U.S. The overall MSCI ACWI index KP is estimated around 30 right now.
30. Is that high historically?
It is quite elevated, yes. And a big reason is the U.S. market.
Yeah.
The S&P 500 CAP is way up there, maybe 37.7 or so.
Wow.
Which really contrasts with international markets. Developed markets outside the U.S. are closer to 18, and emerging markets around 14, much more moderate.
Huge difference.
So if we plug that global KPE of 30 into our model, the CAEY is 1 divided by 30, which is about 3.33%. Add our 1.5% real growth assumption, Add the 2.5% inflation assumption.
Let's see, 3.33 plus 1.5 plus 2.5.
You get 7.33% nominal total return forecasted per year for the next decade.
7.33%.
And we usually present that as a range, maybe give or take a percent. So let's say 6.3% to 8.3% nominal annualized return for global equities over the next decade.
Okay, 6.3 to 8.3%. So what does this really mean for you, the listener, managing your portfolio? Tempering expectations is one thing, but what's the biggest single takeaway from that number compared to what we've seen recently?
I think the biggest thing is realizing why recent returns were so high. The last decade saw something like 11.7% nominal returns globally.
Fire, yeah.
A huge chunk of that came because valuation multiples expanded, CP ratios went up. That was a massive tailwind.
And now?
Now with CPE already high, that tailwind is, well, likely gone. It could even become a headwind if valuations contract or mean revert downwards.
You can't count on rising valuations to boost your returns anymore.
Exactly. It suggests a tougher environment. You need to be much more selective, perhaps, and focus on what you can control. But crucially, remember what we said earlier. High CP isn't a market timing tool for tomorrow or next month.
Right, the compass, not the map idea.
Precisely. It's strategic guidance. And it has limitations, of course. It's backward-looking. Maybe there are structural reasons like changes in accounting or shifts in the economy why maybe a higher CP is justified now than in the past. That's always debated.
Okay, let's recap quickly. The CPE ratio looks like our most reliable long-term predictor. And right now it's suggesting, well, much more modest returns ahead for global stocks. That 6.3% to 8.3% nominal range is quite a bit lower than the double digits we got used to.
Which really leads to a final thought, maybe a question for you to consider. If these higher starting valuations point towards lower future returns, what kind of behavioral discipline does that demand from you as a long-term investor? How does it change how you think about, say, global diversification, or keeping your investment costs super low, or even just the discipline of saving consistently? Something to really mull over in this kind of environment.